more importantly, we just need to see some interest rate certainty. We need to have the market kind of establish a baseline for which we can assess the rate environment going forward. We think that will help with transaction activity. It will help with price discovery. And we think ultimately it will provide a catalyst for the stock, particularly if we get some rate cuts either later in this year or going into 2025.
Joining me today is John Stanner, President and CEO of Summit Hotel Properties. So, John, is there a particular project or initiative currently underway at Summit that you are especially excited about in terms of the ability to generate growth and enhance shareholder value?
Yeah, I think for us, the opportunity set's really more about market mix and location exposure. About half of our portfolio is located in urban markets, another 25% in suburban markets. Those markets have been slower to recover than some of the more leisure-oriented resort markets. And so our exposure to those has been a benefit this year, and we think it will continue to be a benefit for the remainder of the year into next year as many of these urban markets, particularly some of them have been slower to recover, continue to accelerate in their pace of recovery. Markets like San Francisco and New Orleans, Baltimore, Louisville, Minneapolis, we do think that will continue to drive outsized growth for our portfolio. And our team's just done a wonderful job managing expenses in an environment where it's been difficult. So even in the first quarter when we had 1.5% RevPAR growth, we had 80 basis points of margin expansion. And so for us, it's more operating tactics and market exposure that we think is going to drive relative outperformance for us for the year.
And what are some of the key issues that you see impacting your sector in the next 6 to 12 months?
Yeah, I think the big ones are certainly the health of the consumer is top of mind for everyone. And we've seen, particularly for some of the lower end chain scales in our industry, we've seen some softness. I think a lot of that has to do with comparisons to previous years more than absolute softness. In our segments, we're seeing some of the fastest growth rates in the segment, but we're obviously paying very, very close attention to the health of the consumers. You've had kind of multiple years of inflationary expense growth creep and affecting consumers' ability to spend. We're starting to see some thawing of the labor market. That has been a real headwind for us over the past couple of years, is trying to be able to manage expenses when the labor market's exceptionally tight and you've seen above inflationary growth in wage expenses, particularly at the hourly level for our hotels. And the last one is, I think, kind of obviously the interest rate environment has, a very meaningful impact on valuations across all of commercial real estate. Hotels are not any different or not immune from that. We'd obviously love to see some rate cuts, but probably more importantly, we just need to see some interest rate certainty. We need to have the market kind of establish a baseline for which we can assess the rate environment going forward. We think that will help with transaction activity. It will help with price discovery. And we think ultimately it will provide a catalyst for the stock, particularly if we get some rate cuts either later in this year or going into 2025.
And to what extent is Summit seeing acquisition opportunities or the chance to dispose of properties in this market?
Yeah, we've been a net seller of assets over the course of the last 12 months. We sold 9 hotels for about $140 million worth of proceeds. We've sold them for about a blended 5% cap rate. The common thread amongst all of those dispositions have been assets that have generally been lower RevPAR, kind of lower quality hotels for us with significant capital needs. And our view is that in the interim, we can pay down some debt, deleverage the balance sheet, and ultimately redeploy that capital into something that has a better return profile. We haven't been as active as an acquirer as we historically have been. We bought 2 hotels last year, both of them with very attractive yield profiles. They were both kind of low double-digit type of going-in cap rates, highly strategic assets adjacent to other assets that we own in the market where we felt like we could create some complexing of expenses that were, again, more strategic in nature. We'd like to continue to be active. We haven't found the opportunities that we're looking for, and we're trying to be disciplined around where we can deploy capital versus where kind of the implied cap rate is embedded in our stock price.
And we've spoken before about joint ventures, the importance. Is that still an important strategy for you?
Yeah, we love our joint venture with GIC. They've been a really good partner of ours. We have sold a couple of assets out of the joint venture. I think we'll continue to be opportunistic both on the wholly owned portfolio and within the joint venture, both on the buy and sell side. We've been saying, this week in our meetings, I don't know that the light is blinking definitively one way or the other of being a huge seller or a huge buyer. So both on the wholly owned portfolio, I think we're going to continue continue to be very thoughtful and strategic about what we look to buy and sell.